Incorporated coming to you. What is it? It's Friday, and it is Friday, March 20th. So coming to you live here on Friday, March 20th. Thanks for joining me here for my live Facebook Live. And today, as part of the invitation said, we're really going to do a weekly recap. What happened this week, and that recap is going to show a couple things that we want to achieve. Number one, why are rates going up when the Fed dropped rates to near zero last week? And then what were some of the dynamics happening through the Fed this week that have really impacted interest rates? And so we'll go over a couple of those points. And then we're going to end with what I really think is the most important topic to discuss, and that is, what are the fundamentals of a good mortgage transaction or real estate transaction in this environment of uncertainty? And so I hope that'll provide some useful information for real estate agents and borrowers and clients, etc. So before we jump in, obviously want to acknowledge the hardship that people are going through. I'm going to limit all my comments, obviously, to mortgage and the real estate industry, because that's where I work and that's what my interest and expertise is in. But I want to acknowledge that many people are suffering right now around the globe and in our country. And I would certainly want to be sensitive to that. With that said, and the other point I want to discuss briefly is my information source. I use MBS Highway. MBS stands for mortgage-backed securities. Mortgage-backed securities are the financial instruments that create interest rates for mortgages. So my information, my source, is Barry Habib at MBS Highway. He is an expert on these topics. I pay a pretty substantial fee annually to subscribe to his services at MBS Highway. If you want to check my sources, please just Google Barry Habib, H-A-B-I-B, and MBS Highway, and you'll get where I'm getting my information. Okay, so let's jump into it. Let's first start with what's going on in the market. And for me, I'm kind of a visual learner as well. I want to show you a chart, a graph, that I follow that is technical, that shows where mortgage-backed security yields are. And this graph, if you're not looking at these every day, look like a lot of mumbo-jumbo, but it can show a good visual representation of what uncertainty looks like in the marketplace. So, and I'm not going to get into define. I'm just going to spend just a minute on this. I'm not going to tell you what all these lines mean here, what those lines mean. This graph is going from December 30th up until yesterday. I printed it off, or actually today. And you can see in periods of stability here, these are each, the green and the red are days, and it shows where the yields for mortgage-backed securities are trending. And then we get over to here, and holy cow, what happened in this area? It's kind of like, which one doesn't look like the other? And so that's a good framework and foundation to talk about what the weekly recap for this week is. So in essence, you can see in this area right here, this is where yields for mortgage-backed securities are trading on that particular day. It is a huge range. Some of these are 200 basis points or 2%. And so you can see that if we're in that area of those big spikes on each day, that's uncertainty. That's the market trying to figure out what's happening. And so as I look at that technical analysis through time, and I see periods where we see these big changes, I kind of ask myself, well, why? What happened to make the market behave in that way? And so as of what's going on with the coronavirus, we would expect to see this level of instability, and lo and behold, we do. When we get back into this area, notice these ranges are so much smaller in that stability. So this is visually what instability looks like. Now, I would expect as we go through time, we're going to start looking more like this and not like this. So the Fed this past week did a bunch of different things to try to help stabilize the market. So we would expect, as those actions take effect into the market and we stabilize, we're going to come out of coronavirus. I have no idea when. I'm not a medical professional, but we will, and the market will recover, and we're going to start to expect to see those big spikes come down. So let's talk about what happened. Let's just start back last Saturday. On Saturday, I put out a live video talking about why interest rates were rising, and this is before the big spikes, when it looked like interest rates should be coming down, because it's really confusing the market. So I put that out, and it's kind of fun to watch it because I had no clue what was going to happen on Sunday with the Fed, but as soon as the Fed comes in and they drop rates, Monday the markets came along and these big spikes happened. Let's talk about what happened on Sunday with the Fed. First off, they dropped rates to near zero, which everybody knows about. What a lot of people don't know is the Fed did three other things that are very, very important to stabilizing our market over time. The first thing that they did is obviously the rate cut. And then they did something called QE, or quantitative easing. You may have heard that term in times back. To simplify quantitative easing, the Fed makes a public statement that they are going to purchase U.S. Treasuries and that they're going to purchase mortgage-backed securities. What does that do? It effectively takes risk out of the marketplace for the wholesale and retail investors. When I say investors, I'm saying the people that are lending money. Why does it take risk out? Well, in essence, the Fed is saying we have a guaranteed buyer in the secondary market, the Fed, Fannie Mae, Freddie Mac, as long as you originate your loans to conforming standards. Takes risk out, should help stabilize the market. They did that. They had stopped doing it. That's why we saw rates come up, a year ago, et cetera. And now, because of this crisis, they're doing it again. It's a big deal. The third thing that they did, very important, and it was really underrepresented, in my opinion, in the media, is they said, we're going to stop our runoff. So, in essence, when they do this quantitative easing, their balance sheets are expanding massively because they're buying all these securities. Well, in a refinance market, what happens is when that loan is refinanced, the Fed just lets it fall off its balance sheet, and the balance sheet has less assets, liabilities on it. Well, what they're saying now is when refinance happen, when rates return to lower, they're not going to let it run off. They're going to go out and purchase the like equivalent of a security in the marketplace, another factor of stability. Okay? And then we had, the last part is some regulation around Dodd-Frank was changed that allowed banks to lend to each other with less restriction to keep liquidity in the market. So that all happened on the first part of the week, Monday, Tuesday, but rates still went up. And you'll notice I have been saying for a very long time, even before the coronavirus was coming, is we got to be careful rates are too low. Why? Because when rates are this low, we have to worry about inflation, and we have to worry about unemployment. And I was concerned that rates being so low with the refinance capacities that were going on, that we were going to see potentially inflation and unemployment coming into the market. Then the Fed acts and they make their changes there, and the rates rise. And rates were rising because of that activity, but also because of what I spent time on Saturday talking about, the cost structure of the investors, which is the capacity, their runoff from the loans that are being refinanced, and their serving cost structure and their hedging costs. So we had the investors with very high cost structures. We have the Fed kind of throwing this inflationary fuel on the fire. Rates consequently went up. Let's go forward a couple more days. A couple days ago, as the virus is getting, the concerns are getting more pronounced, Steve Mnuchin, the U.S. Treasury Secretary, comes out and says, okay, we're concerned that unemployment may reach 20%. Now, I have no idea where he got that number from. I'm sure it's a good number. I don't think he would say some number that's not reliable. And certainly unemployment is a big issue, concern in our economy right now. Well, as soon as those numbers start to come out, the mortgage interest rates, the investors have to worry about repayment. If unemployment is rising dramatically, they have to reflect that in price as well. So we see interest rates go up because of potential unemployment. Just another point, Goldman Sachs this morning says we could see unemployment in the millions next week. We saw a big spike in unemployment applications this week, which makes sense. We could see it in the millions next week. Well, the market has to reflect that. They have to absorb it, and lo and behold, mortgage rates are going back up again today. So that's certainly a concern. The other part is this. And through the week, the Congress is coming out and suggesting they're going to put relief into the marketplace, trillions of dollars of debt, and that's going to come maybe checks to people, tax deferments, whatever they end up and do, but there'll be trillions of dollars of debt. Now, when the federal government says we're going to send a check to somebody, they just don't go print it out. They fund that money by issuing U.S. treasuries, okay? That debt has to be paid for. It has to be absorbed into the marketplace. Well, if you release a bunch of debt into the marketplace, just think supply and demand. The appetite for the amount of debt, trillions that are going to the marketplace, there may not be a market for it. So what happens is price of that debt goes down. Well, when the price of that debt goes down, mortgage interest rates go up. So now, to recap the week, we had the Fed's actions this past Sunday, Monday. Now we have trillions of dollars of debt coming into the marketplace, and we have unemployment concerns. Well, guess what? We're going to have something that looks like that, and that's how it happens. So I hope that recap kind of explains what happened this week and why we're seeing the instability. Now, I want to transition briefly. I know this is going long. I hope you folks are hanging with me because I think it's valuable. I want to talk about the fundamentals of a good real estate transaction when we're living in a world of that, okay? And here I think is some bright news and good news. Now, the fundamentals, if you're dealing with the first fundamental is you have to be dealing, if you're a borrower, buyer, seller, with a good, solid professional team around you. That team looks like a real estate agent who's maybe seen some cycles before, some instability before, who understands the market in terms of real estate and how it's going to affect. You certainly have to deal with a lender who can explain to you what's going on in the market and why it's going on and what the best guess is for what's going to happen in the future. You might want to incorporate a good CPA, a financial advisor, things of that nature, but you got to have a good team around you. Number one, that's the number one fundamental. And then from there, from my perspective, I can tell you this. The way I approach this business from today in a period of instability to a period of economic growth and expansion a couple months ago, whatever you want to take that time frame back, it's the same. My business model, my advice doesn't depart the framework that I have. And so you can go, I have hours of YouTube videos, I have hours of Facebook Live. You can look at the videos that I put out, and you're going to see that my approach to this business in instability and in a time of stability, it's the same, and my model works. And that model is pretty simple. Number one, make sure if you're a borrower, if you're looking to refinance or purchase, that the financial traction works for you. Look what your family needs in terms of housing, mortgages, and just does it work? Is the house big enough? Do we want to downsize? Is the term of the loan long enough? Whatever that is your family changing or is your job moving? Understand what you need and communicate that to your team. Once you get past that, the way I assess every mortgage is pretty simple. And this is where people sometimes scratch their head, but I can prove it with math all day long every day. Look at the term of the loan. The term of the loan, and this is in air quotes, I don't want to embellish, but this is in air quotes, is so much more powerful than the interest rate. So rates are rising. So that means let's look at how we can really mitigate some of that rising risk, and we do it, number one, with term. So I can write a 29-year loan. A 29 years better than a 30-year loan in terms of cost. I can write a 28-year loan. 28-year loan is better than a 29-year loan, okay? I can do a 24-day lock. 24-day lock's better than a 30-day lock or 45-day lock. By the way, when I say locks right now, a lot of investors are not allowing, because of capacity, anything under 45 days. So just understand that. We have some mitigation there. But let's look at the term and how that term affects the risk of what you need to do, okay? Now, in a period of instability, our threshold for risk is going to be a lot less than a period of stability. I don't discount that. The second thing, if you're buying a house, look at the down payment structure. Do I necessarily want to get into a 97% loan to value right now? I probably don't. Maybe, so I just don't purchase right now. Maybe I wait. An 80% purchase loan to value is much more stable and secure than 97%, okay? So let's look at term, down payment. Let's look at the product. Because of the outcome of Dodd-Frank, our underwriting guidelines and the products in the market today are very stable. Even in times of uncertainty, if we follow those guidelines and we get the right product for that borrower, it does mitigate risk. And when it mitigates risk, you're going to get a better interest rate. Even if the rates are high, you'll get a lower, higher interest rate. Does that make sense? So let's look at the product. And then lastly, we look at the interest rate. If you assess a mortgage in all three of those positions, you have the right team with you, and you put that together, you can still make very good purchase refinance decisions even in a period of instability. Look, I personally believe that rates, once the market sift this out, we're going to get away from this big transition here, and we're going to get back into that period of stability and predictability. Markets like that. We're going to get back here someday. I don't know when it is. If it takes a long time to get into a mortgage today that fit those criteria, that's right for you, that you can repay, and rates continue to rise, you're a genius. If the rates go down, you're going to refinance it. So you have those metrics and those abilities to operate in this period of instability. Okay, I'm going to leave it there. That's where I'm at. I hope the recap was useful for you to understand why rates are going up and why we see these dynamics. And I hope the fundamentals that I'm sharing with you, how you make a good real estate decision, I hope they're helping you. As always, call me anytime, text me. I'm more than happy to chat with all of you. This replay will be posted on my Facebook channel and my YouTube channel as well. Thanks again. I appreciate you, and stay safe.